Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kixula. Today, I've got David Casper on the podcast with me, and we're going to be talking about cost segregation. David just joined my team as an account manager. We've worked together for a number of years. Why don't you go ahead and introduce yourself, David?
Hey, I'm David Casper. Yep, like Brian just mentioned, been working together for a few years, and it's good to be here.
All right, so today we're going to jump into more or less a question and answer. We're in the middle of tax season. We just got past our first big deadline, and now we're going to start getting returns that are going to be due coming for the extension in September and October. We are fielding just a lot of phone calls, and we're going to jump into a couple of misconceptions that we get in cost segregation. And one of the things that I hear all the time is, hey, Brian, your estimate seems a little bit low on your property. I got an estimate from another cost segregation provider, and they were saying I could accelerate 39% of my property. Usually the conversation goes, their fee was also 5 times what yours is, but I still have to justify why is your estimate coming in at, let's say, 15 to 20% accelerated when theirs is coming in at 39%. And the answer is every property is different. So when we're looking at doing an estimated benefit on your property, we're not looking at some Excel spreadsheet and saying, hey, based on, I don't know, an office condo, you're going to expect to see this flat percentage, or based on an apartment complex, you're going to expect to see this flat percentage. We're actually having our team go in, pull satellite images. So it's Google Earth. It's not rocket science anymore. We're looking at LoopNet, or we're looking at Zillow, and we're saying, hey, what is on that property? What type of site improvements? Do you have a swimming pool? What type of interior improvements do you have? And then we're coming up with the calculation of what we expect to find in accelerated depreciation. And not all properties are completed, or not all properties are created equally. Not all properties have swimming pools. Would you agree to that, David? Is that a common question that you're seeing when you're fielding phone calls?
Yes, I definitely see a lot of people who've come in, they've received an estimate from another company that is rather high. And one thing that we always go to is, did they look at the property itself? Because different properties are going to have different attributes, different flooring, pretty much different everything. Each property is going to be unique. So we always want to look at the particular property to make sure that the estimate is going to track with what the result is when we complete a study.
And the reality too, I tell clients, is if you're looking at accelerating 35% plus on a residential property, you better have the short life assets in that property, meaning, does it have a swimming pool? Does it have tennis courts, pickleball courts? Does it have the landscaping? Does it have the short life assets in the interior of the property? Because if it doesn't, let's say you just have let's say you have a standard 3-2 house, you've got tile flooring, you don't have any real site improvements, you've got basic appliances, you're not going to find that much in accelerated depreciation. And the reason why is because you just don't have it. Think about when you build a property. And I think that this kind of comes back to it. It's, what are we doing when we do cost segregation? Essentially, what we're doing is construction cost estimating. So we're saying, okay, if we were to rebuild this property, how much would it cost to rebuild it? So we're looking at clearing the lot. We're looking at putting the slab down, the walls, the roof, the openings, so your windows and doors, your primary electrical, your plumbing, your HVAC, your hot water heater. All of that is your structural components of the building. So all of a sudden, you're spending a majority of your money on the actual structure of the building itself. That is always going to be a straight line depreciation item. Or I shouldn't say always. It seems like nothing is always when you're doing cost segregation, but it's almost always going to be a straight line depreciation item, whether it's a 27.5-year asset or a 39-year asset. Then we start looking at items like your landscaping. So your landscaping, your site improvements, And then on the interior of the property, we're looking at items like removable flooring covers. So not tile. We're looking at items like your appliances. And guys, we all know that fixtures and equipment vary depending on the quality of it. Your standard GE range that costs $900 at Lowe's, that only costs $900. And then if you have to hit it with depreciation because it's 5 years old, that's worth $450. Now, if you had a Vulcan gas burner, commercial grade in your residential property, and all of a sudden that piece of equipment alone is $5,000 to $10,000, that's something that we're going to pick out. That's one of those things that our engineer is going to pick out and say, hey, this isn't just an oven. And I think a lot of cost seg providers are still using like low, medium, and high when they're looking at equipment grade, which might have been reasonable a decade ago, but now you can literally take Google Lens, look at the image of that equipment and pull up what it actually costs to replace it. So it's just really understanding that the assets that are inside the interior of the building. Another misconception that we get hit with all the time is bonus depreciation. Now that we're back with 100% bonus depreciation with the One Big Beautiful Bill Act, David, could you speak on that?
Yep. So what we get a lot of is people who think 100% bonus depreciation means that they'll be able to depreciate 100% of their property. And understandably, given that it's called 100% bonus depreciation. But what it actually means is that all of the short life assets will be able to depreciate 100% of those in the first year. So that has a real impact on both expectations and then also what we're able to find as far as accelerated depreciation.
A lot of clients will come back and they'll say, hey, I replaced my HVAC system. I replaced my hot water heater. I want to take 100% of that in year one. Guys, depreciation isn't really based in reality. And even though we know that your hot water heater is probably going to explode every 10 to 15 years and ruin your house if you don't replace it, don't wait for that to happen. And your package unit or your condenser that sits on the outside of your house for your HVAC system, it's only going to last 10 years. Maybe you could squeeze 15 to 20 years out of it, but the warranty ends after 10 years. That doesn't matter. It's still a 27 and a half year or a 39-year asset most of the time. So we really have to identify the assets that we can accelerate and take that 100% bonus depreciation on. And if you're looking at appliances and equipment, we're looking at refrigerators, dishwashers, microwaves, ovens, wine refrigerators, and a number of other items that we can pull forward into the 5-year assets. But it's certainly not everything. And David just mentioned you cannot depreciate 100% of the building in year one. That's not what the bonus depreciation ties back to. Now, certain assets you can, but we're not covering those today. We're talking about buildings that people live in or work in. That's just not something they could take 100% bonus on. So then a few other things that I wanted to talk about when you're looking at buying a property and doing a cost segregation study on is wins. I wanted to say, hey, we talked about some of the things that are misconceptions, like overestimating the amount of depreciation you take on a property and trying to claim 100% bonus depreciation. Some of the wins are site improvements. I always tell clients, don't shy away from a property that has a tennis court. That's a site improvement. It's a 15-year asset and it qualifies for 100% bonus depreciation. What other assets do you see out there, David?
So a big one that I definitely see is the LVP. So when, especially in places like Texas or Florida, I'll see a lot of tiled floors. And as you mentioned earlier, they're long life assets. So properties that have a lot of LVP flooring tend to be really good candidates, as well as single story buildings. So having less construction work into, say, basements or multiple levels will allow for more depreciation on these short life assets.
And again, it's because, guys, we're doing basically construction cost estimating. So we're going in and saying, how much is it going to cost to replace every component of the building? and then we're putting it in its individual bucket for depreciation. And if your property has a robust structure, so you've got a basement, you've got all of the concrete, you've got the dig, you have to dig out that basement, you've got to form it up, you've got to fill it, and then you've got to build multiple layers on that property. All of the sudden, the structural components of that building are going to be higher, so your short life assets are naturally going to be lower. We run into that a lot with high rises. High rises are tricky to do cost segregation study on. If you think about how much it costs to build a high rise, a steel in concrete building, steel, concrete, and glass, that might be 30, 40 stories, all of a sudden you have a ton of costs that is going into the structural components. Even if you only own an 800 square foot unit, your cost per square foot just to build the structure is probably $500-$600 or more. A few of the other items that I wanted to point out are swimming pools. This is something that we had talked about earlier today. Our estimates tend to be on the conservative side, and we were looking at our estimates on swimming pools. We were estimating them lower on the percentage. So we felt, okay, maybe we're losing some business over this because we're not really looking at that asset closely enough. So swimming pools are absolutely a gold mine when it comes to cost segregation. It's a short life asset as long as it's on the exterior of your building. Guys, if it's on the interior of your building, it's considered structural in nature. If it's a rooftop swimming pool, it's part of the structure. You can't remove it from the building without having a gaping hole in your property. So the IRS considers it 27 and a half year or 39-year component if it's on the interior or part of the structure. But if it's separate, it's a site improvement, 15-year asset. Any other assets that you've seen recently that are really wins for investors when they're looking at buying properties?
So one of the ones that I see that I think is underappreciated is the fencing, especially if you're on a half acre or more. That fencing can really add up. Yeah, the pavers, the patios,
site improvement.
Yep, those will really, sometimes they take up a lot of square footage and they're really valuable. So there's definitely not something to overlook when considering a property.
One of the items that I want to talk about when it comes to short life assets on the exterior of a building, specifically fences, I've had clients that will buy horse property, or they'll buy, I don't know, they'll say it's raw land, it's vacant land, there's no value, there's nothing to accelerate. And all of a sudden, they literally have, I don't even know, thousands of feet of fences, and it is a depreciable asset. It's a site improvement, and it's eligible for bonus depreciation. Another item that we talked about, docks. So if you live on a lake or if you live coastally and you've got a boat dock, a gold mine. I did a study in Charleston, and in Charleston, this property, if you've been to Charleston, when the tide goes out, it can go out 1,000 feet. And that's exactly what happened in this scenario. So the walkway on that boat dock was 1,000 feet long. So if you can imagine a boat dock that cost $75 per linear foot just for the walkway on its way out, plus you have the boat slip at the end, all of a sudden we're talking hundreds of thousands of dollars of an asset that is a 15-year asset. So boat docks are an amazing opportunity for bonus depreciation. Seawalls are the same thing. So if you buy a property with the seawall, if it's a seawall, a concrete seawall, that's a site improvement, 15-year asset, it could be up to $500 a linear foot to replace. So all of a sudden, you've got a very expensive asset that you can take an accelerated depreciation. So that's one of the things that I love about my job as a cost segregation specialist is we get to do, I don't know, a little bit of detective work when we're out at these properties. We're looking for short life assets. When I go to do a site inspection on a restaurant, one of the things that I'm looking for is, are there any grease traps that are underneath the asphalt? Or is there any holding tanks that we need to take into consideration that are a site improvement? So those are, short life assets. And then a segue for the last section of the call is AI in cost segregation. I just want to talk about AI in cost segregation briefly. So AI is definitely something that we have started using. I use it every day. I was out for a walk today and I was talking to the Gemini app, which was super cool. What I asked it was funny. I said, because it asked me to pick a voice. I said, is there any way you could use my voice? So I was just talking to myself on my walk and it actually laughed at me and it said, that's not a feature that it offers yet, but I thought it would be great. So I'd be training my own avatar, which would be awesome. But yeah, we absolutely use AI in cost segregation. Right now, we're using it primarily to help us sort work papers. So work papers are all of the documents that we receive. Think your appraisals, your title reports, purchase contracts, just any of the data that we have to really read through to pick out some of the just some of the metadata that we use before we do the cost segregation study. I'm absolutely integrating AI into the process to help us just take away some of that heavy lift that we do on the front end. As far as the actual engineering on the studies, I've got a team of engineers, I've got a team of accountants that are actually reviewing the build data on each and every one of the properties that we do. And they're reviewing the final numbers before we deliver reports. Do you have anything to add, David, as far as AI in cost segregation?
Yeah, certainly. And like you were saying, having somebody at the proverbial wheel really matters. These studies are going to go to the IRS. So you want to make sure that every single number is correct and not just something the AI pulled. Earlier today, we had to check on, it was just about $500 as far as what the closing cost was, because we had two different documents that had two different pieces of information. So we want to make sure that's going to be correct and not just trust AI to choose the one that it wants to.
Perfect. Hey, with that said, I'm going to go ahead and wrap up the podcast. Certainly want to say thank you for jumping on today.
Most welcome.
And I will talk to you soon. If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.